There we go. All right, so good morning, good evening, good afternoon. I don't know what time of the day it is that you are accessing this recording, but welcome to Learning Unit 6, Accounting for a Manufacturing Enterprise. Guys, we've done quite a long journey. We've been quite on a long journey and we've done quite a long trip together over Learning Unit 1 to Learning Unit 5, and today we're covering Learning Unit 6. And you have seen in the notification that I say that this learning unit will be the culmination. It's going to basically borrow from all the learning units, or let me just say it in another way, it's going to summarize all the learning units. So nothing is definitely wasted in this textbook that we've been covering. And so I believe that you're going to enjoy it, because if you have been engaging with the reading and from the very beginning, and if you've been studious and understanding every single concept, you will find Learning Unit 6 as well as Learning Unit 7 very easy. And in fact, it's basically gonna sort of reinforce whatever you've learned, almost like a recap of whatever you've learned, right? So we're gonna look at terminology charts for the manufacturer. We're going to touch on accounting records of a manufacturing enterprise. There's just a little bit of difference between a manufacturing enterprise and, a retailer or wholesaler. There's just a slight difference there, but it is well explained in your introduction if you've gone through your introduction. If not, if you've not yet gone through the introduction, you have time to catch up. But it's time to really engage with the studies so that we can be done with all the learning units and begin the prep for your final exam. All right, so that's it for my small intro. But yeah, so let's delve in. So manufacturers must account for their inventory in such a way that management and cost controllers can easily detect where in the system there is an over absorption of cost, right? So that's quite true. So that's what you can retain from the introduction, is that there is a way it's being done for a manufacturing enterprise that you're not necessarily going to find in other type of businesses, but it is really for that. It's to see. It's quite critical for to detect where there is more cost than it should, right? And that's what they fear the most, right? Cost controllers and management, one thing that they fear the most is that money is being wasted. And that makes sense, right? You are an entrepreneur, you're going to go into business, whatever business you have, you just don't want to be bleeding money, right? That's the best way I can put it. So you don't want to be losing money or wasting money. So that's the reason why you need to be quite meticulous when it comes to your inventory, making sure that you are not wasting money, right? So we have a general ledger, and that will be the focus actually of this chapter. And as you know, your general ledger, you're going to have the double entry, right? You remember all that from accounting? It is the same thing here, but I'm just going to add a nice progression of these main ledgers, the main ledgers for the manufacturing, right? So in terms of terminology, like I said, you've been dealing with these terms from the very beginning: direct, or raw materials. You know raw materials. And why we call it direct, right? It is because we are able to trace that, right, into the actual final product. So you have examples of leather, but then leather, wood, flour, and cement. But then comes this very important concept of work in process. So the work in process, it's very simple. In other terms, that is the actual manufacturing or production parts, right? So that's what we call work in process. Finished good, we will come back again. We will emphasize again this part, right? But all the costs that you have, whether they are direct or indirect, they need to be attributed. Let me put it that way. They need to be attributed to the working process so that the actual production may start, right? So you have your usual suspect. You know them. The direct material, direct labor, manufacturing overhead. The reason why I'm going slowly on this part is so that we are fully in agreement what I'm talking about. There is no need to rush. You know this. By this time, you should now breathing in, breathing out. You know what we're dealing with. Direct material, direct labor, manufacturing overhead. Manufacturing overhead is everything that is indirect, in other terms, right? So that's all it's about here. You have your finished goods. This is going to be also an account, right? It's going to be an account, and it's going to indicate what has come out of the work in process. All right, so once, and think about your economics. If you do remember your economics, you have the production stage, right? But you have also material that is entering the production and coming out also of the production is the actual product that has been manufactured. It is the same principle here, exactly the same principle, all right? So indirect material, you know this term. Do just a bit more of diligence in reading again. When you're reading this over and over again, you confirm, right? You confirm your understanding, but you are familiar with these terms, right? Direct labor, indirect labor, factory overhead costs. These are costs that are associated with the manufacturing process, but cannot be directly identified in the final product. What does this remind you of? Indirect costs, isn't it? You have your electricity. Can you look at the final product and say, I can see how much electricity has gone into making this product? Obviously not. You can't do that. You can't trace this indirect cost, but you know to manufacture a product, they've used electricity, rent. Obviously, there couldn't even be any manufacturing if we are not paying rent, because we need to have a plant to manufacture product. So there is the idea of rent, right? Whether we built the plant, but we understand that every product that are being manufactured, there is a rental cost that is involved, but we can't trace it to the final product. So I just want to get from you, all of you who are here, Chulumanco, Damon, Mugao, Yainula, is this quite clear, right? We get these terms, right? They're very important, but we understand them, right? Perfect, 100%. No, I like it. So we are again reiterating what we know, emphasizing what we know, But you will understand why we're doing this, because once we start the ledger, the understanding of this is vital, is capital, so that, and I tell you, please go again, even though you understand it, just go again and read again this concept. Fixed cost. You remember your fixed cost, obviously, irrespective of the number of product that is being produced, it is a constant, right? It is fixed. That's the meaning of it, fixed. That will be your rent, your rates, your insurance, right? Variable costs that vary in relations to the number of product that is produced. That will be electricity, wood. It's variable, right? You pay more electricity if you manufacture more, right? If you manufacture more, you will need more direct material, right? Or direct labor. That does make sense, right? And then you have your production cost. What do they mean by production cost? They just mean that costs that are related to the actual production or the manufacturing of a product. If you remember, we did this distinction in one of the learning unit when we had period cost and periods cost. Remember that. So the period cost will be your admin, your selling, your marketing cost, type of cost, right? And we said that that was separate, right? That was more of a period cost. But every cost that is involved in the production, we call it production cost. And that, what would that be? Remember, the three musketeers, as I love to call them. You can call it the way you like it, but it's just to remember, right? You have your direct labor, your direct material, direct labor, and manufacturing overhead. This must be in your blood. Every time you think, you know this. Even if you're sleeping and I wake you up and I ask you, what are those three costs? You know what I'm talking about. Okay, so let's move on now. Now we go to the ledgers, all right? So you have again, reiterated again, we're going to have different ledgers, right, for a manufacturing enterprise, right? So it's part of the general ledger for the manufacturing enterprise. We're going to have a ledger for the direct material. Exactly. We're going to have a ledger for the direct labor. We're going to have a ledger for the manufacturing overhead, right? And this ledger for the manufacturing overhead will include all the costs, right, that are utilized in the manufacturing process, except the direct. So we understand that this manufacturing overhead deals with the indirect, right? We understand that. Yes, sir, we know this. Yeah, I'm just repeating over and over because you will see why I'm doing this, because this is going to be very vital. The work in process, right? I told you that's the actual manufacturing. When you talk about the production, that's the actual ledger for production. So that's where we put the input. Remember again your economics: input, production, output. Input, production, output. So the work in process is the actual production part, right? The middle part there, where we transform the input into output. And we, in terms of costs, we are interested with these three elements of production: direct material, direct labor, manufacturing overhead. We're going to use them in the manufacturing process in order to produce product. So that's clear. What comes out is the output or the finished goods, right? And we're going to have a ledger for exactly that, the finished goods. And what does these ledger? You say, sir, but you are talking about ledger. What are those? They are just a way of balancing. Remember again, we balance. It's basically an account where we're balancing the credit side and the debit side. It's very important to balance the credit and the debit side. There is one side what we are receiving and one side what is coming out of there. That's interesting. So each ledger will have what is coming in and what is coming out of there. Yes, that's exactly what I want to tell you. So look at the ledger as balancing. We need to keep an account of, wait a minute, what came in and what did come out? Okay, that's the purpose of balancing. So for example, for direct material, money will come out and product will come in, right? And those products, we're also going to send them to our manufacturing, right? Or our working process. That's basically the essence of this. Okay. So let me know if you're not seeing my mouse, if my mouse is not moving correctly, just let me know, but it should be fine. All right, so we will have that. Therefore, once we're done with the finished good, what is the next progression? The next progression is that we need to sell those goods. I mean, just logical, right? And once we've sold those goods, then we can look at actually the cost of sales, right? Once we've sold those goods, right? So this is a format of the ledger account. There you have it. For example, for the direct material, you have a debit side, you have a credit side. Debit means money came out. Money came out. And what do we get on the other side? Is the actual product that we sent to the manufacturing. Is this clear? Waiting on you guys. Is this clear? Perfect. Perfect. Come on, guys. Let me know. If there is a problem here, just let me know that you're not getting something. But is this clear? Mugau, Chumako, Damon, Yanula, is this making sense? All right. So if you're looking, if you're looking, for example, at the direct material, you will see the balance. What is that balance? This is the balance from last year. So this, why are we debiting money? Because debiting money, it's been paying money out. So in order for you to get the material, you need to pay money, right? I mean, it's logical. You pay money, money comes out, material comes in. Let me repeat that again. Money comes out, material comes in. We're debiting money, meaning money is going out and material is coming in. All right, so you have, for example, for the direct material, you will have a balance. The balance is basically what happened at the end of the previous year. What happened, what amount of material was left from last year will be included into this year beginning. Let's say maybe we have leather that we didn't finish using, we didn't totally use that leather last year. We were left with some leather last year. At the beginning of this new term of production, or this new year of production, we're going to use the leather that was left last year, right? In fact, in Learning Unit 5, we were looking at the FIFO, remember that, and the weighted average, first in, first out, remember that part. So we dealt with that part when the material is coming in, how we should look at the cost of material, right? But this is also something to understand, that whatever was left of last year will be the beginning, will be included at the beginning of this new year. Trade payable. Obviously, when you hear trade payables, is that you purchase material on credit, right? Bank. Every time you see bank, it means that you had to make a cash payment, right? So for example, bank number 3 there, as you can see it here, bank, you can say that this was for buying material cash. And bank 4 you can see that we are talking about the carriage, railage, and shipment. We need to include that. We talked about that, right? We need to include the carriage, railage, and shipment into the cost of the material, right? And look now at your credit side. You have the working process because the material that we bought, we are going to send we're going to send it to the actual production. But what you need to see is that how do we balance it? The only thing that is not part of this work in process, it is going to be the closing balance here. Look at 7, number 7 here. There is a closing balance. Closing balance, it's basically the material that we are not going to use by the end of the year. Let's say the total of the material we have is 10 rand, but there is 2 rand worth of material that we are not going to use this year. So the actual material that will be sent to the production will be 10 minus 2 that we are not going to use. 8 will go to the actual production. So that's the meaning of balancing those. So we need to balance to see which one will go to the actual production, right? Balance 7 is exactly balance 8. Is it 8 or what here? So 1, 2, 3, 4, 5, 6. Okay, balance 6 and 7, these two, they are exactly the same. It's going to be the same amount. But you will understand it when we take an example. Direct labor, same concept. Whatever has to do with labor, money that we are paying, medical aid contribution, UIF, you know what UIF is, right? All these things that are involved in labor, direct labor. Who are the direct labor? You know them, right? It's the people that are touching the product that are involved into the actual manufacturing, right? Anything that is not this, you should not put it into the direct labor, right? But again, we need to balance. Whatever we've paid out into wages, medical aid contribution, whatever is labor related, it's going to be taken into account when we send this labor to do the actual production. So we are sending, who are we, almost like with the money of your company, the money talks about the people and the material that is going to be used in the production. Okay, so that's how you send people. All right, so let me just take a small break there. Let me check what is the question here. Chulmanko says that while we are debiting money that goes out, I explained that. I hope that's clear. Why is the railage debited? The railage debited because you pay money, you pay out money. I repeat again, guys, debiting money, it means paying out money. Come on, guys. Debiting, meaning money is coming out. If I say money was debited from your account, okay, let me repeat that. If I say money was debited from your account, that's how you even have a debit order. I hope that that's clear, right? Meaning that money is leaving your account. Okay, that's all. So money is leaving, material is coming in. That's clear, right? Would we lose marks if we said creditors control instead of trade payable? No, use trade payable, not control. I don't know why you would use control. Use creditors. You can say creditors, fine. Trade payables. Wouldn't the cost of railage be an expense? Yeah, it is an expense to the company. I'm not too sure why is it confusing. Yeah, Yanula, do you wanna come on? Open your mic.
I'm just confused because the railage is a cost, But the direct material is an asset account, and we would increase it if we are receiving direct material. But the railage is a cost, so I don't know why we would debit it because it's not increasing the direct material account, if that makes sense.
Oh, okay. So look, you add it to the actual cost. So if you think of it in terms of asset, it is because you are dealing with an inventory, right? So at the very beginning, in any case, we'll touch on that. At the very beginning, you are looking at your inventory as an asset. But obviously, that asset won't remain an asset once we use it. Okay? So it's going to form part. Remember, again, we are very clear that there is a distinction between a manufacturing company and a retailer, right? A retailer, you will buy inventory and then you are selling that inventory as it is. But with a manufacturing company, you are transforming that inventory. So at the end of the day, it's going to become a cost of sales. That's where we are going. So I will explain that, and I hope that that will be clear. So that inventory, which is an asset at the beginning, is going to be a cost of sales once we sell the product. Because we are not buying to keep it as an asset, we are buying to transform it. So it will no longer be in the form that it was bought, right? Almost like you are buying leather, yes, but you're going to transform that leather into shoes. So basically, the asset will disappear. You see, but what you need to understand here, and I hope I will do justice to it, is that when we are looking at the money we've spent to buy that asset, we need also to take into account the money it takes us to bring the asset to us, which is the shipment, which is the carriage, which is the railage. That's how every time you buy something on Takealot, there is a shipment cost involved. Every time you buy something from Temu, they say the shipment cost that will be involved. But you need to put, so when you're buying, basically, you need to take all that into account. Let's say you are spending 8 rand to buy a shirt, but the shipment will be 2 rand. So what you need to take into account is not just 8 rand. You need to take into account the total of 10 rand, meaning the cost of the product plus the shipment. All that form part of the cost of the product. So I hope that makes sense. So you just need to understand that when it comes to, and in fact, in the previous chapter, we dealt with this, right? We dealt with this. In any case, I'm moving on now to the last very important input ledger. So remember, we have covered direct labor, direct material. Now we have everything that is indirect, right? But what are those? We already talked about them. Rent. But rent for what? Not for the entire company. So when they're giving you rent, for example, they say this amount of rent was spent. You need to make sure, are we talking about the rent for the factory or the manufacturing part, or are we just talking about the rent for the entire company? So you need to find the factory rent, the factory electricity, the factory maintenance, depreciation of equipment of the factory, right? Everything must be production related, not depreciation of the printer that is in the admin building. So guys, we've dealt with this classification, categorization of costs. We have already dealt with it. So here I'm saying, if you don't remember it or you do not pay attention, you will be messing up these accounts because you will not be counting everything that you need, all the costs. So you need to make sure that when you're dealing with the factory overhead account, take all the costs that are involved, all of them, right? Okay, so I hope that that's clear. But now look what happened on this side. Every time they tell you work in process, because we're going to send all these costs to the work in process. It's almost like we're going to take all these cost into account in our manufacturing or production. I trust that's clear, right? And now we come to the actual work in process ledger account. Okay, remember again, your left and your right. It's well divided. Okay, on your right, obviously, you're going to have the balance of the previous year. Always check if there is a balance from the previous year. They will tell you at the end of last year, there was this amount of semi-finished product or unfinished product, right? It means that they were not able to finish the production of these things last year. So we need to finish them when? This year. All right? So always take whatever was left at last year is going to be taken into account this year. But this time we are not talking about product, we are talking about semi-finished good. I hope that that's clear, right? But what else do we have? We have these three. All these three amounts, work in process, everything that is work in process. No, don't take into account the balance. No, just the work in process. All these three amounts are going to be brought here into this account, work in process, right? So direct material, direct labor, factory overhead, okay? And what we want to find is what will be the finished good. And again, what do? You add up everything except minusing what will be unfinished this year of production. So whatever we are not going to finish, whatever good, semi-finished good, it means that we didn't complete, we didn't totally finish manufacturing the good. That we need to leave it out. Okay, another clear example. We were trying to manufacture 10 shoes, right? But we were only able to manufacture 8. So we need to we need to not take into account the 2 that were not finished. We need only to take 8 because 8 is the finished good. Does this make sense? Does this make sense? Okay, perfect. All right, so I can continue now. We are almost there. And then you're going to have the finished good itself. We're going to have an account just for the finished good. And so what will be there on that finished good? On one side, you're going to have whatever we receive from the work in process, right? And on the other side, we're going to have the cost of sales. What we are going to send to the cost of sales. Why? Patrick, why? Now pay attention. Just because we finish producing a product, that doesn't mean we have sold that product. I repeat, just because we have finished producing. So basically, these finished goods, we're going to put them in one account. And that's what we call the ledger. So accounting helps us to have this well structured in an account, but just with few numbers, right? But we know physically the finished good will be sitting somewhere, right? In a depot, somewhere. They are the finished good. And then we are selling those finished good and they are going out. In fact, Yanula, this finished good becomes an inventory, an actual inventory, you see. They become an inventory that we have. So we have an inventory of finished goods. So now when we sell them, they're coming out, we're selling them, we need to check the cost of sales. That's what it means. That's why you always have what came in, what went out, what came in, what went out. And that's the beauty of this, right? So for example, on this side, you will have obviously the balance of finished good of last year. So last year they produced product, but they didn't sell all of them. Like we said in the example, previous example I used, 2 shirts were left. They were finished, but they were not manufactured, right? We're gonna take them into account into the finished good for this year. What else we're gonna be taking into account? All the product that we're gonna manufacture this year now, right? Let's